So you look at a 124-year-old industrial conglomerate, right? A company built on like sandpaper, masking tape, and chemical adhesive.
Right, the real legacy stuff.
Exactly. And you inherently expect a certain kind of quarterly report from them. You know, you expect to see revenue basically just tracing the broader macroeconomic GDP lines.
Yeah, maybe a few fractions of a percent higher if they manage to push through a seasonal price hike or something.
Right, but overall, you expect a highly defensive posture, a management team focused entirely on protecting the slow, predictable dividend.
Because that's what their business model is, right? It's fundamentally tethered to the traditional physical economy.
Exactly.
Which is, why the market generally prices these legacy mega caps as bonds. They basically treat them as bonds with a very slight equity upside.
A safe place to park money.
Right, they are treated as shock absorbers for a portfolio rather than actual growth engines.
But then you open up the Q2 2026 earnings transcript for 3M.
Ticker symbol MMM.
Yeah, ticker MMM. And that entire defensive, lumbering dinosaur narrative just completely shatters.
It really does. It's wild.
Welcome to this special Talk Tickers edition of the Deep Dive, by the way. Our mission today is to cut through all the corporate jargon and Wall Street fluff to figure out what is actually happening here.
Because we are diving into a corporate reality today, where the company that manufactures your Post-it notes is like simultaneously signing strategic partnerships with Microsoft.
Wait, Microsoft? For what?
To deploy patented next-generation optical technology into Azure hyperscale data centers.
That is just crazy to think about. 3M in hyperscale data centers.
Yeah, they are suddenly sitting right at the critical physical bottlenecks of the artificial intelligence infrastructure boom.
So it completely forces a recalibration of how you value the equity, right?
Oh, absolutely. When you dig into the transcript with CEO Bill Brown and CFO Anurag Maheshwari, the primary takeaway is that the market is severely mispricing this stock.
Mispricing the pace of 3M's internal structural transformation, you mean?
Exactly. We are looking at a company that is violently shedding its historical identity. They used to just be this loose holding company of disparate brands.
Right.
But now they are aggressively integrating into a highly unified operating machine, and they're aiming squarely at the highest growth sectors of the modern economy.
Well, that is exactly the core of our analysis today. We are going to look closely at the raw data from Q2, right? We'll explore the physical mechanics of this turnaround on the factory floor and in their R&D labs.
And we'll analyze what management is projecting for the back half of the year, too.
Yeah, and ultimately we'll piece together a definitive, actionable stance on the stock for you, the listener. So let's jump straight into the data.
Let's do it.
We need to start with the top line, because the organic growth metric here is, it's the first massive anomaly. We are looking at 5.4% organic growth for the second quarter.
Which is huge.
Right. I mean, the street was modeling like 3%.
Yeah, coming in 240 basis points above consensus on organic volume is almost unheard of, especially for a company with a market capitalization of this size.
And especially in the current industrial environment, right?
Exactly. To contextualize that 5.4%, we have to look at the broader industrial landscape right now in the summer of 2026.
Which is pretty stagnant.
Decidedly stagnant. I mean, the purchasing managers indexes, the PMIs, they've just been hovering around that neutral 50 mark.
Right, meaning no real expansion.
Exactly. Capital expenditure cycles in traditional manufacturing have totally lengthened out due to cost of capital concerns.
People don't want to borrow money at these rates to build new factories.
Right. So there's this pervasive wait-and-see attitude among major industrial buyers.
So in that environment, achieving 5.4% organic growth, and we should note that excludes currency fluctuations and acquisitions. Right?
Yes, pure organic growth.
Yeah.
It means 3M is aggressively taking market share. They are not just riding some macroeconomic tailwind.
They are generating idiosyncratic, company-specific momentum.
Yeah, and it brings their first half organic growth to 3.3%, effectively decoupling them from the broader sluggishness we're seeing out there.
Okay, but let me push back a little here. Top-line beats can sometimes be a bit of a mirage, right?
Sure, if they are bought with heavy discounting.
Right, or aggressive marketing spend that just completely destroys the margins. So it's like getting an A+ on a midterm, but you basically bribe the tutor to take the test for you.
That's a good analogy. Yeah. But here, the profitability metrics actually outpaced the revenue growth.
Oh, wow.
Yeah, the operating margin hit a record 24.9%. It expanded by 40 basis points.
So they hit almost 25% operating margin.
Yes, and that drove EPS, or earnings per share, up 11% year over year to $2.40.
Okay, an operating margin approaching 25% is the metric that should have every institutional investor's attention right now.
Absolutely. Because in the realm of physical manufacturing, where you are, dealing with raw material logistics, global labor forces, energy costs.
And physical depreciation of massive assets.
Exactly. Retaining a quarter of every single dollar as operating profit requires ruthless efficiency.
So a 40 basis point expansion indicates, what, a high operating leverage?
Bingo. It means the incremental revenue they brought in from that 5.4% growth was highly profitable.
They didn't have to go build a new factory or hire a massive new sales force to capture that extra $240 million in volume.
Right. It simply drops straight down the income statement to the bottom line.
Which naturally leads us to the cash generation. Free cash flow came in at a massive $1.3 billion for the quarter.
Which reflects a 107% conversion rate, by the way.
And management is being incredibly aggressive with capital allocation. They deployed $1.4 billion in shareholder returns this quarter alone.
Break that down for us.
Sure. So that's $400 million in dividends and a staggering $1 billion in share repurchases.
Just in one quarter.
Just in Q2. And if you zoom out to the first half of the year, they've bought back $3 billion in stock at an average price of roughly $153.
See, that share repurchase velocity is a massive signal regarding management's internal valuation models.
What do you mean?
Well, when a mature company with $1.3 billion in quarterly free cash flow chooses to aggressively retire its own equity rather than stockpiling cash or going out and looking for external acquisitions.
They're saying the stock is cheap.
Exactly. They are broadcasting a belief that the intrinsic value of the company is significantly higher than the current trading price.
Right. And by retiring those shares, they artificially enhance the EPS for the remaining shareholders.
Yes, but they also permanently reduce the dividend burden going forward, which frees up even more cash flow in this great virtuous cycle.
Okay, I look at these numbers, though. The margin expansion, the cash flow conversion, and my immediate instinct is still skepticism.
Why is that?
Well, because we have seen a lot of legacy companies post sudden margin expansions over the last few years simply by pushing massive price hikes onto their legacy customers.
Ah, right, masking a stagnation in actual unit volume.
Exactly. So I have to wonder if we are just looking at a company flexing its pricing power in an inflationary environment. Or is there genuine physical volume growth and operational optimization happening on the factory floor?
That's the million-dollar question. And if we look closely at the bridge that CFO Anurag Maheshwari provided for the operating profit, we can actually answer that definitively.
Okay, let's hear it.
So operating profit increased by $110 million in the quarter, right? If this were purely a pricing story, we would see volume acting as a heavy drag on that number.
Because they'd be selling fewer units at higher prices.
Right. But instead, the transcript reveals that a massive $240 million benefit to operating profit came exclusively from a combination of organic sales volume growth and broad-based factory productivity.
So the underlying physical throughput of the business is actually increasing.
Yes. That implies they are genuinely manufacturing more goods and pushing them through the system more efficiently, rather than just, changing the price tags on a shrinking number of pallets.
Wow. And is there a metric that proves that efficiency?
There is. The clearest, most undeniable proof of that operational efficiency is buried in their working capital metrics.
Yeah.
You mentioned the 107% free cash flow conversion earlier.
Yeah, that massive $1.3 billion number.
Right. Well, a primary driver of that cash generation was a 7-day reduction in inventory turnover compared to the same period last year.
Oh, wait. A 7-day reduction across a company of this scale.
Yes.
That seems almost impossible to achieve in a single year. I mean, we are talking about a global footprint with roughly 100 manufacturing plants, tens of thousands of suppliers, and massive distribution networks across dozens of countries.
It's massive.
Taking a full week of idle inventory out of a system that complex requires a fundamental rewiring of the supply chain.
It is a monumental logistical achievement. Historically, legacy manufacturers operated on this just-in-case inventory model.
Right, holding massive safety stocks of raw materials and finished goods at localized distribution centers just to prevent stockouts.
Exactly. And that ties up billions of dollars in working capital. But what 3M has done over the last 18 months is heavily digitize their supply chain forecasting.
So they're getting smarter about what they need and when.
Right. They are implementing these advanced demand sensing models. It allows them to shift from localized safety stock to centralized regional hubs.
Oh, that makes sense.
And they're also rationalizing their SKU counts, basically killing off the low volume, highly complex variants of products that just clog up the production lines.
Like getting rid of the weird neon green tape that nobody buys so they can make more of the standard blue tape faster.
Exactly. And they are increasing the changeover speed of their manufacturing equipment too.
So when you combine SKU rationalization with predictive demand modeling, you don't need goods sitting on a warehouse shelf for an extra week.
You don't. You free up that capital, and it flows directly into the $1.3 billion in free cash flow we saw this quarter.
So the efficiency gains are structural, not circumstantial. The broader economy isn't booming, which forces us to look internally at the specific engines driving this 5.4% top-line acceleration.
And this brings us to the story behind those headline numbers.
Right. Let's transition into part 2 here. Because CEO Bill Brown spent a significant portion of the call detailing their commercial execution.
He really did.
He highlighted the deployment of new data-driven tools for the sales force, specifically aimed at territory planning and cross-selling.
And the numbers they reported on cross-selling are actually quite revealing.
Yeah, they had $110 million booked in the quarter, with another $120 million in the pipeline. That represents a 40% quarter-over-quarter increase in the pipeline alone.
The cross-selling metric is perhaps the most crucial indicator of 3M's cultural shift right now.
How so?
Well, for decades, 3M operated as a classic conglomerate. They had deeply siloed divisions.
Oh, I see.
Yeah, the adhesives team had their own P&L, their own sales force, and their own customer relationships. The advanced ceramics team had theirs. The personal safety division had theirs.
So they weren't really talking to each other?
Not at all. You had scenarios where, like, a 3M adhesives representative would secure a massive contract with an aerospace manufacturer, walk out of the client's procurement office, and have absolutely no mechanism or incentive to mention that the client should also be buying 3M respiratory protection gear for their factory floor workers.
So they were basically leaving hundreds of millions of dollars of wallet share on the table simply due to organizational friction.
Exactly. But by breaking down those divisions and restructuring the incentives so that the sales teams are acting as integrated representatives of the entire 3M portfolio, they are finally leveraging their scale.
Right. The cost of customer acquisition plummets when you are simply expanding an existing multi-million-dollar vendor relationship instead of cold calling someone new.
And furthermore, they reported that customer churn, or the attrition rate of their existing client base, improved by 200 basis points.
That's huge for B2B.
Oh, in B2B industrial markets, retaining your existing contracts is the absolute foundation of organic growth. When churn drops by 200 basis points, the new cross-selling revenue doesn't have to fill a leaky bucket.
It stacks directly on top of the stabilized baseline.
Exactly. It accelerates the overall growth rate exponentially.
But the commercial engine can only sell what the engineers invent, right? Which leads us to their new product introduction, or NPI, machinery.
The R&D side of things.
Right. 3M has historically built its entire brand equity on advanced material science. But management openly admitted on this call that the innovation engine had grown somewhat sluggish in recent years.
They did. But they have spent the last 24 months implementing what Bill Brown refers to as the R&D factory.
And the output metrics of this overhauled process are pretty impressive. They launched 92 new products in Q2 alone.
Which is a 44% increase from the same quarter last year.
Yeah, and they're projecting 350 product launches for the full year and targeting over 1,000 product launches by 2027.
And more importantly, they have compressed the development cycle time by 20%. They are bringing a product from the ideation phase to the factory floor in roughly 250 days.
That velocity is critical, right? But we must differentiate between the types of innovation they are funding. Not all 92 of those products are game changers.
Right. Management categorizes these launches into different classes.
Oh.
Class 3 products basically represent iterative improvements.
Like what?
Perhaps a new formulation of an existing abrasive that lasts 10% longer, or maybe a new adhesive with a slightly faster cure time.
Just minor tweaks.
Yeah, these are necessary to defend existing market share, and they currently make up about 75% of their pipeline.
Okay, but the long-term margin expansion relies on what they designate as Class 4 and Class 5 products, right?
Exactly.
With Class 4 being the deployment of an existing core technology into a completely adjacent market.
Yes.
And Class 5 representing entirely novel inventions engineered for entirely new markets.
Precisely. They are explicitly targeting a shift in their portfolio weighting, aiming to push those Class 4 and 5 products to over 40% of their total launches within the industrial and transportation divisions.
That's a big shift.
It is. This is where you see the transition from defensive market share maintenance to aggressive, total addressable market expansion. You don't get premium margin profiles by tweaking a 20-year-old product.
Right, you get them by solving novel, complex bottlenecks in emerging industries where the customer is relatively price insensitive to the solution.
Bingo.
Which transitions us perfectly into the most vital segment of this entire earnings analysis. This is the specific technological catalyst that completely alters the investment thesis for 3M.
The real hook the quarter.
Yeah, I am referring to their announcement regarding expanded beam optics, or EBO, and their strategic deployment partnership with Microsoft for Azure data centers. To grasp why a legacy industrial company is suddenly a critical bottleneck player in the hyperscale AI build-out, we really have to look at the physical limitations of current data center networking.
It's fascinating. The bottleneck in the artificial intelligence arms race isn't just the manufacturing of the GPU chips themselves. Yeah.
Right. It's not just getting the NVIDIA chips.
No, it is the physical infrastructure required to connect tens of thousands of those chips together so they can process massive data sets in parallel.
And to achieve the necessary bandwidth with minimal latency, data centers rely entirely on fiber optic cabling.
And the vulnerability of a fiber optic network lies in the physical connections.
Right. Because in a traditional single-mode fiber optic cable, the core that transmits the light is incredibly small. It's roughly 9 microns in diameter.
For context, a human hair is about 70 microns.
So it's microscopic. And when technicians are building out a data center, they have to splice or connect these cables by the thousands.
Which is a nightmare. Aligning two 9-micron glass cores perfectly requires highly specialized, expensive labor and extremely delicate fusion splicing equipment.
But the real enemy is environmental contamination, isn't it?
Oh, absolutely. A single microscopic speck of dust, perhaps 50 microns wide, can completely obscure a 9-micron core. That causes massive signal loss or total connection failure.
And the environment inside an active data center construction site is not a sterile clean room.
Far from it. It is a construction zone filled with drywall dust, concrete particulate, vibration.
So traditional optical connections are intensely sensitive to these conditions.
Yes. And when a hyperscale like Microsoft is pouring tens of billions of dollars into capital expenditures to stand up AI capacity, the physical labor of cleaning, aligning, and testing thousands of fragile optical connections becomes a severe temporal bottleneck.
Because speed to deployment is the single most valuable metric for a hyperscaler right now. Whoever gets the compute capacity online first captures the software revenue.
Exactly. This is where 3M's material science pedigree intercepts the software world.
Right. They have engineered the solution called expanded beam optics.
EBO.
Yeah. Rather than attempting to perfectly align two microscopic glass cores, EBO utilizes a precision-engineered lens embedded in the connector.
Which does what exactly?
Well, this lens takes the light signal exiting the 9-micron core and collimates it. It essentially expands the beam into a parallel column of light that is significantly wider, perhaps 150 microns across.
Okay, so it gets way wider.
Right. Then it passes this expanded beam across a small air gap to a receiving lens, which refocuses the light down into the receiving fiber core.
The physics of that expansion is the absolute genius of the product. By expanding the optical footprint, the signal becomes highly resilient to contamination.
Right, because if that same 50-micron speck of dust lands on a 150-micron expanded beam lens, it only occludes a small fraction of the total light.
Yes, the vast majority of the signal still transmits successfully, and the error correction protocols in the networking hardware can easily handle that slight degradation.
So it completely eliminates the need for pristine cleanroom conditions during installation.
Completely. 3M has effectively created a blind mate, or basically plug-and-play connector for hyperscale networking.
The technician doesn't need to surgically clean and align the fibers anymore. They simply push the connector into place.
And the data management presented on the call shows that this EBO technology cuts installation time down by 85%.
85%. When you are deploying miles of fiber and tens of thousands of connections, an 85% reduction in labor time translates to data centers coming online months faster.
And 3M has meticulously protected this innovation. They have ring-fenced the EBO technology with roughly 100 granted patents and another 50 currently pending.
So they possess a near monopoly on the intellectual property required to mass produce these highly specific precision lenses at the tolerances required for data center throughput.
They do. And we really have to quantify the scale of this opportunity.
Right, because it's massive. Management estimates that the total addressable market for this specific high-speed optical connector segment is currently sitting at $1 billion.
And they are projecting that TAM to double to $2 billion by 2028, which is just 24 months from now.
And honestly, given the exponential trajectory of AI capital expenditures we are seeing from Microsoft, Amazon, Meta, and Google, projecting a $2 billion TAM might actually be heavily sandbagged.
It probably is. And currently, 3M is only pulling in about $40 to $50 million in revenue from this segment.
So the runway for multi-year triple-digit growth in this specific vertical is just massive.
Huge. And to capture that growth, they are aggressively expanding their manufacturing footprint. They stated they are doubling their EBO production capacity this year, and they plan to double it again next year.
Furthermore, they are being strategically brilliant about adoption because they realize that a hyperscaler like Microsoft will not adopt a proprietary standard if they are locked into a single supplier.
Right, because a single point of failure in the supply chain is an unacceptable risk for Microsoft.
Exactly. Therefore, 3M is actively fostering a multi-supplier ecosystem, partnering with 44 other manufacturers, including chip makers and contract assemblers, to license and integrate EBO so it becomes the ubiquitous industry standard.
With 3M sitting right at the center of the IP web, just collecting the licensing and component revenue.
It is the ultimate manifestation of moving from a legacy industrial posture to a high-growth infrastructure play.
Absolutely.
Now, while the EBO narrative dominated the forward-looking excitement, the earnings call also highlighted strong geographic execution in more traditional segments, too.
Yeah, they reported broad-based international growth, notably achieving double-digit growth in China.
Which runs totally counter to the prevailing macroeconomic narrative, right? Where many Western industrial companies are seeing significant contraction in the Chinese market due to domestic economic headwinds and geopolitical friction.
The success in China is a direct result of their localization strategy. Rather than engineering a product in St. Paul, Minnesota, and attempting to export it to Chinese buyers, 3M has localized their entire new product introduction apparatus within China.
So they are designing products in Chinese R&D labs, specifically tailored for the local industrial requirements, and manufacturing them in local facilities.
Yes. This bypasses a tremendous amount of supply chain friction and allows them to capture domestic market share even in a decelerating macro environment.
Similarly, they highlighted India, which just posted its 7th consecutive quarter of double-digit growth.
Driven by rapid industrialization and heavy infrastructure investments by the Indian government.
Okay, but a comprehensive analysis requires us to aggressively interrogate the weak spots in the quarter too, because this was not a universally flawless report.
No, it wasn't.
The primary drag on the overall business came from the consumer segment, which constitutes roughly 20% of their total revenue.
This is the division responsible for the legacy brands we all recognize. The Scotch tape, the command hooks, the Filtrete air filters, the household sponges.
Right. And that specific segment contracted by 2.1% in Q2.
Management was actually quite specific regarding the mechanics of that contraction, though. They attributed the weakness directly to aggressive inventory destocking by key retail partners that materialized late in June.
We need to explore the mechanics of that destocking because it really provides a window into the U.S. consumer mindset right now.
Right. Retailers operate on these highly sophisticated algorithmic inventory management systems now.
So when a major retailer, think of the massive big box chains, sees even a slight deceleration in foot traffic or a shift in consumer purchasing behavior away from discretionary goods and toward essential groceries, their algorithms immediately adjust the optimal inventory levels down.
It is a classic bullwhip effect in supply chain dynamics. If a retailer decides they no longer want to hold 4 weeks of inventory for a specific SKU of household sponges, and instead only want to hold 2 weeks of inventory to protect their own working capital, they simply halt purchase orders to 3M until that inventory bleeds down to the new target level.
And 3M feels the acute pain of that halted order flow, even if the end consumer is still buying the sponges at a slightly reduced, steady rate.
Exactly. And management noted that the U.S. consumer remains highly cautious, heavily value-focused, and is actively trading down or deferring non-essential purchases.
Alongside the retail destocking, we saw sustained softness in the auto aftermarket division and the consumer electronics space as well.
Yeah, the auto aftermarket weakness is fascinating because it is tied directly to physical behavior.
Collision repair claims are down, meaning fewer cars are in body shops requiring 3M abrasives, masking tapes, and automotive adhesives.
And the consumer electronics contraction, which was down in the low single digits, is heavily tied to upstream supply chain constraints.
Right. Management specifically pointed to ongoing shortages in memory chips, combined with elevated component costs,
which are forcing original equipment manufacturers to scale back production volumes for discretionary devices like personal computers, tablets, and smartphones.
And 3M supplies highly specialized films, adhesives, and thermal management materials that go into those devices. So if the OEM builds fewer tablets because they can't source the memory chips, 3M's volume drops proportionally.
Yeah, they are forecasting the electronics end market to remain down in the high teens for the back half of the year.
But this specific dynamic where the consumer-facing divisions are contracting while the industrial and technological divisions are expanding, it serves as a real-time stress test for 3M's portfolio construction.
It really does.
Because for years, activist investors and Wall Street analysts have argued that 3M is simply too sprawling, that a company has no business manufacturing advanced data center optics in one division and kitchen sponges in another. They argue for breakups to unlock pure play valuations.
The counter-argument to the breakup thesis is portfolio resilience. And this quarter is the textbook demonstration of why that diversity can be highly protective.
Explain that.
Well, the safety and industrial segment, along with transportation and electronics, which together comprise 80% of the total business, grew at roughly 7%.
Okay.
That massive industrial engine effortlessly absorbed the 2.1% contraction in the 20% of the business exposed to the consumer.
So if 3M were a pure play consumer goods company, this quarter would have been a total disaster.
Exactly. If they were a pure play auto aftermarket supplier, the stock would have been severely punished.
But by housing these disparate cycles under one corporate roof, the strength in hyperscale data centers and aerospace adhesives completely masked the weakness in retail destocking. It provides an incredibly durable floor for the earnings base.
It really is a powerful floor.
All right, so with the complex reality of the first half fully laid out, let's transition to part 3. We have to look forward.
A guidance.
Yes, management's guidance for the remainder of 2026. And honestly, it is arguably the strongest signal of their internal confidence because they didn't just maintain their outlook, they aggressively raised guidance across every critical financial metric.
Which is pretty bold.
Yeah. They bumped the organic growth forecast for the full year up from 3% to greater than 3.5%. They increased the EPS guidance to a range of $8.50 to $8.95, which is a 27-cent increase at the midpoint.
That represents 9 to 11% year-over-year earnings growth.
And finally, they raised their free cash flow generation estimate by $100 million, bringing it to a massive range of $4.7 billion to $4.9 billion for the year.
Raising both the floor and the ceiling of the EPS guidance range halfway through the fiscal year requires a profound degree of visibility into the order book.
Definitely.
When a CFO raises the bottom end of the range, they are mathematically eliminating the downside scenarios they had modeled just 3 months prior.
Right. They are signaling that the structural efficiencies we discussed, the 7-day inventory reduction, the R&D cycle time compression are permanently embedded into the margin profile, not just some one-off quarterly anomaly. But I do want to scrutinize the underlying assumptions of that guidance because there is a glaring headwind explicitly detailed in the transcript.
The oil inflation.
Yes. Management noted a significant increase in their inflationary burden, specifically tied to oil and petroleum derivatives. They raised their oil inflation estimate for the year from $125 million to a range of $150 million to $175 million.
That is a $50 million unexpected drag on operating costs.
And petroleum is the foundational feedstock for an enormous percentage of 3M's portfolio. The chemical adhesives, the polymer films, the synthetic resins. So if their raw material inputs are suddenly $50 million more expensive, how are they simultaneously raising the EPS guidance by 27 cents?
It's a great question. Are they sandbagging, or are they just banking on an unrealistic acceleration in volume to outrun the inflation?
The mechanism they are relying on to neutralize that oil inflation is pure pricing power. This is the delicate price-cost dynamic that every manufacturing executive has to navigate.
And management was incredibly transparent about the math here. They acknowledged that the $50 million increase in raw material costs creates a 20 basis point drag on their overall margin rate.
However, they instituted broad, targeted price hikes across their industrial portfolios beginning in May.
Right. And they expect those pricing actions to contribute roughly 1.5% to their total growth for the full year, which implies a localized pricing tailwind of about 2% for the second half of the year.
Meaning the absolute dollar value of the revenue generated by the price hikes will fully offset the absolute dollar value of the increased oil costs.
Exactly. It will be entirely dollar neutral to the bottom line, even if the strict percentage margin takes a microscopic mathematical dilution.
The ability to push a 2% price hike onto an industrial customer base in a stagnant macroeconomic environment without triggering a massive loss of volume is a serious testament to the highly engineered, specialized nature of 3M's products.
Oh, absolutely. If you are an aerospace manufacturer relying on a highly specific 3M advanced structural adhesive to bond the fuselage of an aircraft, and 3M raises the price by 2%.
You do not switch to a cheaper, unproven competitor.
No way. The switching costs, the recertification delays, and the catastrophic risk of failure far outweigh the slight increase in material costs. They are selling mission-critical components, which grants them highly inelastic demand.
And the confidence required to execute that price hike and immediately raise full-year guidance confirms that they are operating from a position of profound strength.
They explicitly stated that they are tracking significantly ahead of the long-term strategic commitments they laid out at their Investor Day last year.
Remind me what those were.
Well, they had promised the market $1 billion in above macro growth over the multi-year plan. And they are already on track to deliver $450 million of that this year alone.
Wow.
They also promised to achieve a 25% operating margin by 2027. And as we discussed, they essentially touched that 25% mark this quarter, a full year and a half ahead of schedule.
When a legacy management team underpromises and overdelivers to this magnitude on structural operational targets, the market is forced to completely reevaluate the multiple it is willing to assign to the earnings.
Which brings us to part 4, the bottom line.
Yes, the synthesis of all this data, the ultimate verdict for the retail investor listening right now.
Based on the structural supply chain overhaul, the R&D acceleration, the highly defensive pricing power, and the massive technological catalyst sitting in the pipeline, our stance on 3M is unabashedly bullish.
Very bullish. The actionable takeaways here completely reshape how you should view this stock in a diversified portfolio.
Let's lay them out. The foremost takeaway is that the multi-year turnaround narrative is no longer just a projection, it is a mathematical reality.
Right, because for years, the equity was fundamentally uninvestable for many institutions because of massive, unquantifiable litigation overhangs regarding the PFAS forever chemicals and the combat arms earplug settlements.
Those issues totally dominated the balance sheet and the corporate narrative. And concurrently, their organic growth had effectively flatlined. They were viewed as a stagnant entity just managing legal liabilities.
But the data today proves the operational transformation has taken root. They have moved from a trailing 12-month revenue decline of 4.4% in 2023 to positive 3% growth today.
They have expanded their operating margins by 500 basis points over the last few years.
And you do not expand an industrial margin profile by 500 basis points through accounting tricks. You achieve it through the systemic, painful restructuring we discussed today.
Streamlining the siloed divisions, optimizing the global footprint, digitizing the supply chain.
The second, and perhaps most vital takeaway for the modern portfolio, is that 3M has evolved into a stealth infrastructure play for the artificial intelligence megatrend.
This is the coolest part. When retail investors look for AI exposure, they crowd into the obvious, highly saturated trades, the GPU designers, the semiconductor foundries, the server rack assemblers.
And the valuations of those pure play tech equities are priced for absolute perfection. Any slight miss, and they tank.
But 3M offers a completely different entry point.
Yeah.
You are acquiring a profitable, highly diversified, cash-generative industrial powerhouse that pays a reliable dividend.
Which just happens to hold the patented optical technology required to solve the most critical physical bottleneck in hyperscale data center construction.
It is the ultimate backdoor exposure. You are buying the microscopic, dust-resistant picks and shovels of the AI gold rush, but you are buying them at an industrial value stock multiple.
And finally, the third takeaway is the proven resilience of the portfolio. We detailed the very real macroeconomic headwinds battering their consumer division.
The retail destocking, the cautious U.S. shopper, the sluggish auto aftermarket.
Yet, despite 20% of their business operating in a contractionary environment, the broader enterprise still crushed top and bottom line expectations. That is the very definition of a durable earnings floor.
It forces a philosophical shift in how we analyze legacy manufacturers. Wall Street has a profound bias toward the new, often dismissing century-old companies as inherently incapable of participating in next-generation technological revolutions.
But 3M is demonstrating that deep, multi-decade expertise in physical material science is actually the prerequisite for building the infrastructure of the digital future.
Exactly. Innovation is not exclusively the domain of software startups. It is engineered in the industrial labs that understand how to manipulate light, mitigate heat, and bond advanced materials at a molecular scale.
And that is the thought we want to leave you with today. If a 124-year-old conglomerate known globally for masking tape can successfully restructure its internal R&D to become an indispensable partner in Microsoft's multi-billion-dollar artificial intelligence ambitions, well, the landscape of value investing requires a new lens.
It really does.
It demands that you ask, what other seemingly boring traditional industrial equities are currently sitting on vast, unrecognized repositories of specialized patents and material science expertise, just waiting to be unlocked by the physical demands of the AI revolution?
The infrastructure of the future requires physical engineering.
And the legacy industrials might just be the most mispriced technology stocks on the market. Thank you for joining us on this Talk Tickers deep dive, and as always, keep digging into the data.